This is the video for Chapter 3, Part A, Low-Income Filers and Federal Credit-Only Returns. There will be two parts to the Chapter 3 videos. To start with though, I just want to encourage you to take a look at the UFile library we have on your Google Classroom and review the navigation video that we've put in there to give you a sort of an overview of the basics of the UFile program, how to get used to entering the information and navigating from tab to tab. Having that familiarity before you listen to the rest of the video here will help you to be able to follow along. So what we're covering in Chapter 3 are facts about federal credit-only returns and some specifics about the type of income we would normally see in these low-income or zero-income tax returns, most of which is reported on the slip T5007, and that is where your employment and income assistance or EIA benefits as well as your workers' compensation benefits get reported, and plus other provincial government benefit programs show up on those slips as well. We'll also talk a bit about social assistance paid by a First Nation band or council and how that is treated on a tax return. In our Part B of our Chapter 3 video, we will discuss the federal refundable credits that are triggered as a result of filing these zero-income or low-income tax returns for things like the Goods and Services Tax Credit, the Canada Child Benefit, the Universal Child Care Benefit where applicable, and the Canada Workers Benefit. So first of all, some facts about federal credit-only tax returns. An individual who has zero income can still be eligible for some refundable credits to be paid either as part of their tax refund or as additional benefit programs paid throughout the year following the filing of the tax return. But the only way to ensure eligibility for those programs is by submitting a tax return every year. The credit programs will typically recalculate every July following the tax year that is in question, and so if an individual files a tax return late, they may see that their benefits are either delayed or stopped altogether. And the GST and the Canada Child Benefit are the ones that are the most common ones that people will be looking to receive. The Canada Child Benefit comes to single parents or two-parent households with dependent children in their homes. The GST comes to single individuals as well as families with children. In a case where there are two parents heading a household, or in a situation where there are two partners who are together in a relationship, both of them need to file their tax returns in order to be able to ensure the household gets their Goods and Services Tax Credit and or their Canada Child Benefit. Even if one of the partners has zero income, they must still file a tax return, so the information is on record with Canada Revenue that this person's income along with this person's in a couple situation is now reported to qualify the household for the various credits. If they don't both file, then the credits will stop until both of those returns are received. It isn't uncommon in the tax returns that we do to see clients who have maybe got unfiled tax returns, so they're not coming in solely to file the return for the current year. They may have either gaps in their tax filing from several years, or they may have not filed their return for a decade or more. In order to qualify for the federal refundable credits of the GST and the Canada Child Benefit, it is possible in circumstances to go all the way back 10 years to prove eligibility for those, as long as all the tax returns are correctly filed for those years. Provincial credits, which we will actually talk about in more detail in subsequent chapters, are statute barred after 3 years if the individual had never applied for them before, and so only the last 3 years of tax returns can generate a provincial refundable credit as part of the refund. Before we go any further into the content of Chapter 3, it would be a good idea for you to pause for the moment and just open your UFile software to the most current year you have and begin the process of starting to take a look at that and follow along as we will talk about how we will enter various things into the software. Again, a reminder, if you're not familiar with the UFile software, you might want to look at the navigation video we've provided in your Google Classroom. So to open your UFile software, you're going to double click on the icon on your desktop for the most current year. And many of you will find that what will pop up is a request to know whether you want to update your computer with the most current version of that software. And you can click on the Get Latest Updates bar underneath the Start button in order to ensure that your UFile version is current and up to date. This is especially important when you have uploaded the new version of the software in 2020, as it sometimes takes some time before they have worked out any issues or bugs or glitches that they become aware of. So regularly updating your UFile software will mean you're using the most current version to do the tax calculations for our clients. So we are going to see more often than not social assistance slips, or EIA, Employment and Income Assistance Slips, which are the T5007 for many of the clients that we serve. And these are the income that is shown on those slips is reported as income on line 14,500 of the tax return. But it is actually a non-taxable benefit. So it gets reported as income on one line. It affects the net income level for that individual, and it is net income that is used to calculate eligibility for the various federal refundable and provincial refundable credits like the GST. But it is subtracted out from net income to remove it from the taxable income calculation. So it's tax exempt, you don't pay tax on it, but it does go in as income, affect net income, come out before taxable income, so there's no tax paid on it. When there is a household who is receiving benefits for more than one person, there's only one T5007 slip that is issued for the household, and it will have the social insurance number and the name of just one of the adults in the home. And if that individual, if there's no other income in the household, then the social assistance will be reported on that person's tax return. However, if there are two adults in the household, the rule is that the EIA benefits will be reported on the tax return of the individual with the highest income. So if one of the partners happens to have some casual labor, perhaps some pension income, or a T4 from an employment source, then the social assistance slip will end up on that person's tax return, even though the social insurance number that's shown on the slip may belong to the other partner. And when we are doing tax returns for partners, we will typically try to do them together as linked tax returns. So you're filing totally separate returns, but the software links them together. So it will know when you've entered the social assistance into one person's tax return, but the partner happens to have a higher income, it will move that slip automatically over to the higher income earner. And it does that seamlessly, no matter how you've entered the information. There's an exception here though. So while social assistance does show up on the tax return and affects the net income, which impacts those credits, and it comes out so you don't pay tax on it, social assistance that is received by an individual that comes from their First Nation band or council will not show up on a T5007 slip. And even if the individual has a statement from their band or council saying this is how much they might have received over the year, that income, social assistance from a First Nations community, does not ever show up on the tax return. It is not reported as income and taken out as a deduction. It simply is never reported. So if we see clients who will indicate that that is their source of income, we would actually identify in the UFile software that they are an individual with no income to report, because that income does not ever affect the tax return at all. So the EIA slip T5007 is actually a federal slip. However, in Manitoba, there is an additional box added to that T5007 slip that has a substantial impact on the potential refunds for clients here in our province. And so that box is added separately on the far right side of the T5007. And what is reported in there is a fraction, and that fraction represents the amount or the proportion of monthly budget, essentially, that EIA has said is still available to be able to be received as part of the tax refund. Since the refundable credits in the province of Manitoba are funded by the Manitoba government, and the EIA benefits also come from the Manitoba government, somebody who has received 100% of their income from Manitoba EIA program during the year and had no offsetting other resources and has been on the program for the whole year, they have already received all of the benefits from the provincial government they're entitled to receive through that program, and they will not get anything more from the tax refund programs. And so what would be shown in that box 14 is the fraction of 0. It has the impact of wiping out any possible provincial credits. So this is a really important box to pay attention to, and it is only shown on T5007 slips that are related to the EIA program. Here is what the slip actually looks like. So in our example here, we can see that there is a box 10, which is workers' compensation, box 11, which is social assistance payments or provincial or territorial supplements, social insurance number. This is a report code in box 13, and here is the extra box 14 that is added separately to the federal slip. And it is that box 14 that is going to determine what the amount and eligibility for provincial refundable credits are on a return of an individual with EIA benefits. How do we get that into the UFile software and make sure the software correctly calculates the benefits is by first of all selecting from the navigation pane under interview setup, social assistance benefits. If you can't find where that is, you can look on the bottom of your navigation pane where in bold it says where to enter. And then in the search field, you can key in T5007 and it will take you directly to where you would enter this information. But when you click on the social assistance field on the navigation pane, it will open to an option to open the T5007. When you open it, it'll look like what is on our screen here, and we'll see that whatever is in the boxes that are on your T5007 is matched in your entries on the fields here. So we don't have workers' comp in this situation, so there's nothing in box 10, but in the example we just looked at, there is box 11, $9,000 shown on the T5007 slip. So we enter that in there. The next box it asks, did you have a spouse or common law partner when you received the benefits? The default for the software is to say yes, and that is why it would automatically transfer any amount that is on that slip to the higher income earner if that was the case in a couple situation. If you don't want it to say yes, I received it while I was with my partner, then you will need to tell the software no, as is indicated in this case. But box 14 again is that most important box, and what will happen if you don't enter something in here is the software will not allow you to proceed with calculating the return. And that's a fail-safe to make sure that we don't inadvertently calculate a payment that is too high for an individual because we forgot to put in the 0 that is shown in many of the box 14 slips that wipes out the benefits. So we will not be able to calculate the return if we don't enter something. And what goes in there should be what is in the box 14 figure of the slip that we are looking at. The T5007 slip, though, is also used for other provincial government programs that are not EIA or social assistance. So there may be other government benefit programs such as the Manitoba 55 Plus Income Supplement that gets reported in the same box on the T5007. It is also a non-taxable benefit, goes in and affects the income but is taken out before the calculation of the taxable income. However, there is no box 14 shown on that particular version of the T5007 because it isn't a significant enough program. It is not an EIA program, and it should not wipe out eligibility for the provincial credits. But we need to make sure the software can distinguish between those two scenarios because it still shows up in box 11 as if it's the same as the EIA program. So what's really important to pay attention to here when we look at an example of one of those slips, it looks very much the same except for two things. One is that the payer here is clearly not going to be the EIA program. It will be a provincial government program often, or in some cases it's a federal program, but it'll clearly indicate that it is not the EIA program. So that's our first indicator that this is different than the normal EIA welfare or social assistance benefits that reduce our provincial credits. The second thing, though, is that this has not got a box 14 figure. So that is clear that there is no extra box added there, so that makes it very different from the normal EIA benefits. Do not mix up what is here under box 13, which will often have a 0 in it as a report code. Don't mix that up with what should be the box 14 figure. It's a very different box, and it clearly says 14. So in this scenario here, this income from the 55 Plus Income Supplement Program should not disqualify this person from being able to receive the provincial credits. So we need to make sure the UFile software knows that. And we'll do that by entering the information just as we did for the EIA person. However, what we're saying here, we know it's not EIA, there was no box 14, but since the U file will not allow us to calculate without there being something in the entry field for box 14, we will need to put a 1 in the box in this case, which will essentially mean that now the software will calculate 100% of the benefits that they should be receiving from the provincial refundable credits. So you don't have a box 14 shown on there, means you must put a 1 in our U-file entry to allow it to correctly calculate. The other kind of income that is shown on a T5007 that we'll see regularly here in Manitoba is the Manitoba Workers' Compensation benefits. But you'll see that that is actually in a different box. So that's in box 10, it's not in box 11. When we have an entry in box 10 here, we don't need to worry about the box 14 U-file entry because it's only applicable to when we've also entered something from box 11. So it'll be entered in our software very similarly, except of course it is in our workers' compensation field instead of social assistance, and then we can not worry about box 14. And the software will allow us to correctly calculate this because the connection between box 14 is only when there's something in box 11. Workers' compensation benefits are also non-taxable benefits. They are reported as income on the tax return, but then they are also, and which affects the net income. Net income is what is used to calculate those refundable credits, but then the workers' compensation benefit in full is deducted from the net income, so that it is not part of the taxable income and will not cause any taxes to be owed on that amount. So take a look at Chapter 3, Part B video for the finishing of our discussions around low-income filers and federal credit-only returns, and we will go through the different federal refundable credits and see how that impacts the refunds for the clients we serve.